is for you. Let's say you're a real estate investor and you're looking to invest in the United States. We have a special guest who's going to blow you away. Let's say you're a Canadian, you want to invest. Up there, we have some ideas for you. Or if you have any ideas that are really going to help you as far as getting in commercial property finance, our special guest is going to be able to help you. Bryan Hickman, thanks for being here, buddy.
Greetings. Thank you.
All right. I'm all excited about this because, as you know, we have a lot of Canadian investors who are now coming down to the United States and they want to buy commercial property. They're wanting to buy, multifamilies, big buildings, et cetera, especially because, we're doing a lot more commercial property finance with our commercial property finance team. So this is going to be a huge added value. But now, why don't you tell a little bit about yourself, then we could get it going and really kick it off in high fashion.
Sounds good. Thank you. So my background is in commercial real estate investment, starting about 20 years ago at a company called Welltower, which when I joined had about $2 billion in assets under management and about $30 billion at the time that I left, focused primarily in seniors housing and other healthcare investments. And then I moved to a competing firm, Invest, which is a Canadian domiciled corporation investing predominantly in U.S. senior living assets, and placed several investment transactions there. It was a very rapidly growing organization when I joined and had the opportunity to get really creative with my deal making and in my roles, I've generally been responsible for, underwriting the entire capital stack, meaning thinking through the equity, returns on equity, the debt, getting the right tranche of debt, but then also looking at different ways to raise equity for particular deals, because there's not just mortgage lending, there's mezzanine lending, there's preferred equity investments, and then traditional equity, and understanding kind of where each tranche should get in terms of returns.
Wow. So, and it's fair to say, you've been advising clients from all over the United States, even up in Canada, correct?
Yeah, that's right. So I've done deals from Florida to Washington, California to not quite Maine, about as far as New Hampshire. But then some of the more interesting deals I worked on at Welltower included Welltower's acquisition of the Rivera Senior Living portfolio. That's Rivera, who is probably mostly known as a long-term care operator, has a tremendous private pay senior living business, and Welltower bought a big part of their business. And I've also been involved in transactions in the United Kingdom. So I've sort of seen how organizations work to manage currency / exchange rate risk, and also try to optimize their tax outcomes.
This is music to my ears, my young friend. Wow. Okay. You're perfect for a lot of our marketplace. So let's get right to it then. I'm going to leave this kind of open-ended because I know this is your field, but let's say I'm a Canadian investor. I want to buy a multifamily or a big building worth $10 million in the United States. I understand there's some tax favors as it relates to me being a Canadian as an example. Throw out some ideas that can add value to me.
Yeah. So, for example, Invesque, the last place where I was again Canadian domicile, British Columbia, investing predominantly in U.S. seniors housing assets, and there's a variety of strategies that help hedge exchange rate risk and help manage your taxable income. And for a company that was domiciled in Canada, they borrowed exclusively in the United States as it relates to mortgage debt. And there's a couple of reasons for doing that. Number one, you get a natural exchange rate hedge without having to buy any kind of swap or sort of exotic financial instrument that is not usually available to sort of a small market or mid-market investor. In other words, you are borrowing in the native US dollar currency. You're paying your debt in the US dollar currency. And so what you're repatriating is a smaller portion of the capital stack. It's really just the return on equity versus repatriating a big portion of the capital stack and being subject to that. We've seen the US dollar versus the Canadian dollar go from $1.25 to $1.40. You don't want sort of those monthly fluctuations to impact your returns. You want something a little bit more predictable. The second is if you're thinking about a high growth profile, In other words, you're not just making one investment and sort of set it and forget it, but really you're looking to place one investment, then two investments, then four, six, whatever. And you're looking to build sort of a critical mass to then flip to a big institutional investor, which is a very viable strategy. What you're doing along the way is accumulating all kinds of incremental depreciation, what I've heard referred to as the depreciation tax shield, meaning that you are almost exponentially building your depreciation expense. And that is helping to reduce your taxable income, particularly in Canada.
Wow, this is perfect. Okay, let me ask a couple more questions then. So, because you're U.S. based, obviously you're managing director at vastsolutionsgroup.com, then
Yes.
the commercial property finance group. So, because you're located here, I would assume that really helps you in working with Canadian clients that need to get financing in the U.S. Correct?
I believe that it is very beneficial to have someone based in the United States that knows credible lenders depending upon your niche. I obviously know a tremendous amount about those that are focused on debt underwriting for seniors housing. But I will tell you that there are many of the same players that are interested in the multifamily space. It's having someone who has worked through the debt underwriting process in the States, I think is very valuable to Canadians because, KYC, know your client type regulations, among others that are a product of the unfortunate events of, 2001. They've changed how people look at foreign capital. So having a U.S. advisor, I think, can be very beneficial. The same way that when Welltower went across border to source debt in the United States, often relied on groups like Brookfield, one of the biggest asset managers in Canada, to help sort of advise them on their debt strategy.
Yep. So what about let's like broaden it a little bit. What about do you work with people who are in the UK trying to invest in the United States as an example?
More the other direction, which is U.S. investing in the U.K., which maybe sounds a little counterintuitive, but it's a product of the fact that there are certain, again, like private pay seniors housing is a very small niche in the UK that has really exploded over the past 15 years with lots of development. One of the real differences in development in the UK versus the US is the entitlement process. It takes 18, 24 or more months to even think about putting a shovel in the ground. And it's a product of historical landmark status. Most buildings have some designation, or at least I should say the development sites that are highly desirable for high class assets, they take a long time to work through the entitlement process. Sort of like trying to think through the entitlement process developing in New York City or San Francisco. We have also markets in the US that are rather high barrier to entry, product of the fact of low land availability and long entitlement process.
I understand. So then, by the way, why senior housing? Why? Let's say I'm a Canadian investor. Why should I even look at senior housing? Is that a good market for me to get in to try to buy commercial property as far as senior housing goes?
When you look at the statistics around demographically, the U.S. and Canada are very similar. We have an aging population that needs care. And when you look at the institutional settings that are available in the United States, private pay seniors housing is by far and away a better opportunity or option for seniors that have the financial wherewithal to pay for care than the alternative, which is skilled nursing. These are individuals that to break down the underwriting, it's pretty easy. Most 75 to 80-year-old individuals have 80 to 90% equity in their home, meaning that when they sell, all the cash is going straight into their pocket. That gives them the financial wherewithal to be able to finance their own care without bothering their children or grandchildren, for that matter, to help sort of finance their stay in seniors housing. And when you look across the landscape, I'd say the average rents in private pay seniors housing are $5,500 to $6,500 a month, which seems like a big ticket, but you get a lot for that, right? You get all your housing, you get meals, You get assistance with activities of daily living. It's a tremendous product, and it's one that is in recovery mode. So if you look at the average investment opportunity in seniors housing today, prices are around $150,000 to $175,000 a door, and I'm speaking U.S. dollars. If you were to replace those assets, your replacement cost tends to range somewhere from the $250,000 to $300,000 a door. So people are attracted to the space right now because you can buy below replacement cost, which is always a good price point, and there's very muted construction activity. That's a product of the pandemic. The pandemic really drove a lot of people away from wanting to develop seniors housing assets. So you have a rapidly aging 75 to 85 demographic. I'm talking about years old in that case, that is growing double digits in the coming years on a percentage basis. And that's your primary group to which you're marketing your services as a seniors housing operator. So the dynamics are really set up well for sort of exponential NOI growth. And you'll see the institutional investors in the space, like the Welltowers, the Ventoses, they're chasing as many of these opportunities as possible because they love the favorable dynamic where you're getting assets at well below replacement cost, and the fundamentals are only going to get better.
Wow, you know what I've learned from this? Not only are you a nice dude, but you're a very smart dude, man. You're the guy to talk to. If there's a Canadian who wants to get in the U.S. market and make some money, senior housing is a good spot to do it. Plus, you know your thing about, you know a thing or two about finance as it relates to commercial properties. This is pretty interesting. This is a big deal for me. I'm so glad we're talking.
Seniors housing is a great niche. I mean, there's always opportunities in office, but multifamily is another great product type because we have, as I'm sure you know, Kenner, a housing shortage in this country, where that hangover from the 08-09 crisis led to just a lack of development for multifamily and single family product, and as a result, housing prices have never been higher, and I don't think that dynamic is going to change, at least as it relates to single family. But there are definitely opportunities in multifamily. Again, lots of deals that you can buy below replacement cost, attractive cap rates, with value add opportunities.
Yeah. So what would you say, because so many people are kind of newer into commercial properties, or they're investors in whatever, in single family homes, and now they want to get into multifamily or senior housing, commercial properties. What's one word of advice or one kind of idea that you think it makes sense for someone who's, again, into, single family residences, but they want to start investing in commercial property? Give an idea to someone in that camp.
And I say this wearing my seniors housing hat, but it applies across asset types. And that is, you really need to know your operator, know who your operating partner is. That's probably
define operating partner. Define operating partner.
Yes. So, what? Like, for example, in seniors housing, it's the guy who manages the day-to-day operations, who is responsible for directing the care that happens within those buildings. But you have the same sort of thing in multifamily, where you're going to have a property manager who's making the day-to-day decisions around things like repairs, around things like what's our policy going to be with respect to renewals and month-to-month leases, and how we're going to do rent increases. Making sure that you know someone who is super experienced in that local market is very important, because there are a lot of generalists who will say, yes, I can manage properties in Florida as well as I can in New York, when in reality, there are, not only sort of local regulatory differences. Again, that applies to really any asset class, but there's also just local relationship knowledge. Am I getting the best price for my electrician? Am I getting the best price for my plumber? That's the kind of stuff that, or do I employ my own? Having someone with a platform who's pricing going in, and who's going to make sound decisions, because ultimately, whatever manager you're working with across asset classes, they're they're managing your money. So underwriting the operator is something that I learned very early in my career that I think is fundamental. And so having someone who can help identify whether it's seniors housing, multifamily, et cetera, a good operator is really important.
Yep. Yeah. Nice. So, and by the way, so because it sounds like we're talking big numbers here. I know for VastSolutionsGroup.com, our minimum kind of on the finance side is really $2 million. What's really your minimum, personal minimum, and then also, what's kind of the perfect size of investment that you want to help out with, or maybe debt side that you want to help out with? I'm trying to learn a little bit about you specifically in your practice.
So again, I look at things with my seniors housing hat on generally. Most of the sort of what you would call commercial real estate in seniors housing is 60 to 80 units. And so 60 to 80 units on, call it $150,000, you're talking about a $9 to $12 million total deal, which means then you're talking about, $6 to $8 million of debt. And the difference obviously being the equity component. And like I mentioned, it's not one size fits all. There's different financing strategies that you can employ. For example, if you like a little bit higher leverage point, there's mezzanine options that can get you to 80-85% in terms of total loan to value. But that's sort of a typical deal in the States. Now, there are much bigger ones, those that are sort of already strong performing seniors housing assets that are trading at a 7 to 8% cap rate. Those will trade anywhere from 15 to 20 million. So you're then applying that same 70 to 80% loan to value ratio. And again, I'm talking about individual properties. It's fairly common right now to see assets come to market in 2, 3, 4 asset portfolios, and it's a product of the fact that you've got a lot of folks that developed in the late 90s, early 2000s, have maybe been developer and operator, and but are now staring down the barrel of a challenging refinance and are saying, maybe I just want to take my chips off the table. And there's a lot of opportunities like that right now.
And you mentioned mezzanine financing. Do you do a lot of that? Do you help out with that specifically?
I don't do. I have not done a lot of it, but I am very aware of that product type, and it is somewhat frequently utilized in our space.
The reason I ask that because there might be someone who's kind of, let's say, from Canada or wherever. They come from the single family investing space, and then all of a sudden they want to get into commercial property finance. They might not have whatever the $2 million, so they need mezzanine financing. That's the reason I asked that.
The pro and con is it tends to be the con being it's a little bit more expensive than traditional mortgage financing. But the pro is you are benefiting even more from that native currency interest, that exchange rate risk. So like with anything in life, there's risks and benefits. So but in each case, you can make a rationale for or against.
I understand. So what's kind of one thing that we haven't discussed thus far that really can add value for someone? Again, we're kind of, I guess, focusing on the Canadians, but on a Canadian investor who wants to get in the commercial property finance space, what's one kind of last tidbit that you can add some value for one of those people?
I guess I dovetail with my prior remark about, underwriting your operator. Know the market you want to invest in and have a rationale for it is ideal. Like, for example, I live in a Rust Belt state. So most of the deals here are, well below replacement cost. I'm talking about multifamily right now. Most of the deals are well below replacement cost. They're a pretty easy underwrite because they're generally pretty stable. You're not going to expect sort of outsized rent growth. Compare that against, let's take a rapidly growing market like Dallas. If you're going to invest in Dallas, you want to understand the local market dynamics, what suburbs are growing, which ones are sort of already established and likely to sort of be a coupon clipping scenario. Where are you going to be able to push rents? If that's what your goal is, that's a sort of a inverted way of saying think about your investment parameters. Are you looking to clip a coupon? In other words, earn a predictable sort of monthly income from an investment? Or are you more IRR, or internal rate of return driven? Meaning, are you looking at the total return over the investment and looking to maximize that? Meaning, are you happy to take more of a back end loaded payoff, where maybe you're buying something that's 60, 70% occupied, and when it fills and you can flip it for, now you're trading on a cap rate basis. Like, is that the return profile that makes sense to you? And real estate investing, like so many things, is not a one size fits all approach. It gets to what your risk tolerance is, and what your desires are for your equity.
Yeah, I guess this dovetails that. So what's with that little idea? What's kind of the downside? Now going back to your senior housing, and I should have asked this earlier. What's the downside of investing in senior housing, in your opinion?
The downside. See, the one of the things I always like to think about when I'm looking at a real estate investment is, what is that worst case scenario? In other words, like, what is my alternative use? And the nice thing about seniors housing is it's fairly adaptable, because it can be reconfigured into traditional multifamily. A more common play recently has been repurposing seniors housing into behavioral health assets. So you think about like addiction centers, or centers for those that have they're not able to take care of themselves, perhaps because of a developmental disability. That's the kind of stuff that you see repurposed. So that's one of the things I've always liked about the asset class is that it is dynamic from a repurposing standpoint. I guess the only negative that I would see about the space is the lending environment, especially right now, is choppy. Lenders that were very active in the space 10 years ago have, in many cases, gone pencils down and said, we want to see the fundamentals improve beyond where they are today. Construction remain quiet, and then we'll look at underwriting again.
But that's why I like dealing with you, because you're right. I think you're right. In general, I think a lot of the lenders are kind of going away, putting their pencils down, as you say. But that's when someone who's senior, someone who's senior who really knows the space, not only that space, but just commercial property financing in general, can add value. Because someone who's never been through this, their career's been whatever, they've been in business for 5 years, they don't know how to deal with this. People like you can add value big time, because you've been through this. You know exactly. You have the relationships. You know what it's like to, deal with bankers who have their pencils down. Maybe you can, bring them up again, and with your experience. And I think that expertise is huge.
I've had the fortune or misfortune of investing and managing assets through both the good cycles and the bad cycles. 0809 was a difficult cycle for everyone in the United States, as a product of the banking collapse. And then obviously the pandemic that impacted everybody across the world. That was also a challenge to, again, not only look for investment opportunities, but manage performing and underperforming assets and lender relationships throughout. Yeah,
this is going to be a huge recording. All the people who are out there listening and watching, who really, let's say they're Canadian, they want to do business in the U.S., and they want to do business in a good asset class, family living, multifamily, or as an example, senior living. Clearly, you're the guy to talk to. I really believe that based on what you've said. You really are a good dude. I'm so glad you're on board. So I'm assuming you're on our website. Why don't you go ahead and mention how someone can get a hold of you? Because obviously they need to get a hold of you, because there's going to be some people who are going to want to.
Yes, absolutely. So if you're at vastsolutionsgroup.com, you can find my profile on the team page, or you can reach out to me directly. My email address is Bryan, Bryan, at vastsolutionsgroup.com.
Yeah, I'm so glad you're on board. And for everyone else who's out there listening to the Vast Voice, watching from wherever you're watching from, hopefully we have added some value, because I'm very confident that Bryan will be able to add value to you, an investor who's looking to get into the commercial property finance space, senior housing, multifamily, wherever the case is. Stop by our website, as Bryan mentioned, vastsolutionsgroup.com. Once again, thanks for watching and listening to the Vast Voice. telling business secrets to entrepreneurs. Once again, this is Kenneth French. I really appreciate you spending the time. It's been a fun time as always. Bryan, that was good.